Hey everyone, welcome back to another dividend investing video. Stocks have been dropping dramatically over September, and the volatility has definitely continued here into the month of October. These are crazy times we're living in, but regardless, I've just been sticking to my plan of buying quality dividend growth stocks and boosting that passive income every single week. This month I'm focused on 4 stocks in particular, and I'm going to share my investment thesis on each one, putting my money where my mouth is. In this video, I'm highlighting stocks I'm personally buying that I see as great opportunities here in the month of October 2023 as we begin to wind down the year. So we have a lot to cover, so let's just get right into it. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. All right, so the first stock I'm going to highlight that I've been buying in October is Lockheed Martin, ticker LMT. Now, Lockheed Martin, it's a security and aerospace company that operates in 4 segments: aeronautics, missiles and fire control, rotary, mission systems, and space. It is the world's largest defense contractor. In 2013, it received 10% of the entirety of the funds paid out by the U.S. Pentagon. So this was always a plan to highlight this stock for October. But in recent days, some extremely unfortunate events have taken place in the Middle East. And it honestly made me reconsider highlighting the stock just as sort of a timing thing. Look, above all, I want to express my sympathies to all those who've lost their lives and lives of their loved ones, the innocent. Now, shares did climb recently. They went up after news of this conflict increasing in Israel, and shares have been up about 4% in the last month. We saw similar movement in the stock when Russia invaded Ukraine back in 2022. So the stock responds when things happen, conflict increases. Year to date, shares of Lockheed Martin are down 8.5%. Let's zoom out further though. Looking at the total return over the last 10 years, Lockheed Martin has returned over 350% to investors, which is a massive improvement on the S&P 500, what that did in the same time frame. Lockheed Martin shares are trading at a forward PE of 16.0, and this is practically in line with its 5-year average. And by dividend yield theory, shares are yielding 2.89%, which is 9% above the 5-year average, which is an indication that we could be potentially undervalued right now. Now, Lockheed Martin pays out quarterly in the months of March, June, September, and December in the amount of $3.15 per share for a total annual payout of $12.60 per share. Have your shares by November 30th to get that next dividend payment on December 29th. Plenty of time to get in for that. Now, the percentage of earnings paid out as a dividend is 46% over the last 12 months, leaving more room for Lockheed Martin to continue paying and, more importantly, growing their dividend payment. Simply Safe Dividends assigns Lockheed Martin a dividend safety score of 84, rated very safe, making a dividend cut extremely unlikely. Lockheed Martin has a dividend growth streak of 21 years of consecutive increases, with an average annual dividend growth rate of 9% per year over the last 5 years. Now, just the other day, on October 8th, 2023, Lockheed announced its latest dividend raise at 5%, and have also announced a major share buyback program. Speaking of share buybacks, how about this? In 2013, there were 327 million shares outstanding, and today there are 258 million shares outstanding. That is a 21% reduction in the amount of shares outstanding over the last decade. Return on invested capital is 34% over the last 12 months, so Lockheed is a firm that has consistently brought in above average returns, far above average. The average analyst price target is $487.76, representing about 12% upside from where Lockheed Martin shares are trading today, so this could be a great opportunity. And I get that some might prefer to avoid investing in this particular industry. These are all individual decisions we have to make for ourselves. I do choose to invest because I don't discriminate against any so-called quote-unquote sin stocks, but I totally respect those who may feel otherwise. Now, global conflict is an unfortunate reality of our world, and so the need for these defensive contractors is going to always exist. And when I look at the companies in this industry, Lockheed Martin strikes me as the best managed of the group. And so I'm a buyer at these levels and will continue to accumulate this one long term. The next stock I'm talking about today is Next Era Energy, ticker NEE. So Next Era Energy, this is an American energy company and the largest electric utility holding company by market cap. Its subsidiaries include Florida Power and Light, Next Era Energy Resources, Next Era Energy Partners, among others. Now, Next Era Energy Partners, which trades on its own as ticker NEP, is a publicly traded subsidiary of Next Era Energy, cut its growth guidance in half earlier this month, which caused stock prices of both to tumble. And I think this has gotten way overblown, creating a wonderful opportunity. One has otherwise been an excellent dividend growth stock that has always traded on the expensive side, at least in more recent years. Now, despite having regained a little bit of its losses this last week, Next Era Energy is still down over 20% in the last month. And year-to-date shares have fallen a huge 38.5%. Next Era's share price had even dipped below that $50 mark earlier last week, and shares have since started to recover. Now today, as I publish this video, Morgan Stanley is reiterating its buy rating for the stock. I think things may have gotten a little overblown. So if you look at the last 10 years, Next Era Energy, despite this near 40% drop, is still beating the S&P 500 on a 10-year basis. So from a total return standpoint, you'd be sitting on 227% worth of gains between dividends and price appreciation holding this utility company. Now, Next Era is trading at a forward PE of 16.4. It's taken a nosedive as its 5-year average is at 28.1. This was trading as a pricey stock for quite a while. It's possible this era of higher rates could change this, making it not as big as a discount as it might seem, something you might want to keep in mind. Now, from a dividend yield theory standpoint, NEE looks seriously undervalued, like ridiculous. This 3.5% dividend today, 62% higher than the 5-year average. The qualified dividends paid out quarterly in the months of March, June, September, and December, paying out 46.75% for a total annual payout of $1.87 per share. The dividend makes up 57% as a percentage of forward earnings, and we like to see this below 75% for utilities, and it's doing what it seems to usually do. It was starting to climb slightly over the last 10 years, but in more recent, it's started to come back down. Now, SimplySafeDividends.com gives Next Era Energy a rating of 90, very safe. This was downgraded just about a week before I made this video when it was at 99, and this was due to that Next Era Partners news we discussed with their anticipated slowdown. Now, still this score of 90 rates higher than the majority of utility companies' stocks, making it a safer looking dividend than most in the sector. And a dividend cut is extremely unlikely with Next Era Energy, I think. In this era of higher rates, it's good to keep tabs on their debt situation, right? I would say it's nothing out of the ordinary for Next Era Energy. From a net debt to EBITDA perspective, they're at 4.96, which is just sits under that 5.5 preference. And yes, we want this under 5.5. What that represents is how many years of EBITDA would it take for Next Era to resolve all of its debts. And net debt to capital sits right below the 60% preference, so right there, not out of the ordinary. Now, the average analyst price target for Next Era Energy is pretty insane. It's $76.60, representing 43% upside from current levels. I think that's possible. I think these are going to be adjusted downwards, though probably, so I would take them with a grain of salt. It's entirely possible that in this era of higher rates, like I said, price and valuation could start to look a little different than it has in more recent years, like a lower PE, for example. Not to mention, more investors will look to safer, lower risk places for their yield due to just how high rates have come up, right? So we can't say whether or not the bottom is in, maybe not, but I think this makes an intriguing long-term opportunity in a high-quality dividend growth company. That's Next Era Energy. All right, the next stock I'm talking about today, I think is a good value, is PepsiCo, ticker PEP. Yes, Pepsi, it's sitting right around its 52-week low, just above the $160 mark, and I'm happy to add to my own position when it's around this range. PepsiCo Inc. is one of the most known food and beverage brands in the world. They are heavy into snack foods like Doritos, Cheetos, Lay's, in addition to the soft drinks that they produce. And they have divisions in every corner of the globe where you can find Pepsi products in some form. Stock prices have been dropping recently across the consumer staples sector as a whole, and as Pepsi had come up to a nearly $200 share price, it's fallen back to what I think is getting close to a compelling long-term place to start. In the last month, shares are down about 9%. Year-to-date, shares of Pepsi are down nearly 10%. It could fall a little more. You never know. We don't know what will happen in the short term, but Pepsi has a fantastic track record of being able to grow its share price and its dividend. In the last 10 years, on a total return basis, Pepsi has brought back 172% returns. Granted, this has underperformed the broader market by about 40%, but I'd argue you own stocks like Pepsi or big rivals like Coca-Cola, Hershey's, not to beat the market, but for the relative safety due to the lower volatility these stocks generally provide. Not to mention that sweet, reliable dividend income, right? Now, when a stock like Pepsi drops 10%, it's notable. At a forward PE of 21, it's really hard to call Pepsi quote-unquote cheap, right? But you have to consider the company we're talking about. High-quality companies often trade at a premium. Right now, it's at 12.5% discount to its 5-year average PE. Likewise, the dividend yield of 3.11% is 10% lower than the 5-year average yield for Pepsi, which is another signal of potential undervaluation. Pepsi has a somewhat odd payout schedule. It does the March, June, September thing, which is very common, but then it pays in January, not December. But at the moment, they're paying out $1.265 per share each quarter for a total annual payout of $5.06 per share. Now, the dividend today takes up 65% of forward earnings, passing the criteria of below 70% that we like to see. These are typically on the high side for food companies like this. Consumer staples are known for their juicy dividends and the cash flow they bring in. SimplySafeDividends.com, where I get a lot of these great charts I display. They give Pepsi a very safe rating of 93, making a dividend cut extremely unlikely. Now, Pepsi finds itself in the elite category of dividend kings with more than 50 years of consecutive dividend raises. It just hit that this year. Quite an accomplishment, and that dividend is still being raised at a higher than average amount. The latest back in February announced was a 10% boost over the prior year. This has been one of the most reliable dividend growth stocks on the market for the last 50 years. And we see Pepsi doing the steady share buybacks. Shares outstanding have declined from 1.56 billion in 2013, and today they're 1.38 billion shares outstanding. And return on invested capital is at 20% for the last 12 months. Look at that consistency. Pepsi's management has shown that it can consistently produce above average returns, and I am here for it. The average analyst price target is $188, representing over 15% upside from where shares trade today. Now couple that with a 3.1% dividend. I like where this one is at. I definitely prefer it to competitor Coca-Cola, which is another stock I do think is worth looking at right now. I did a comparison video a few months back when neither of these were buys. You'll see they both come quite close to my target buy prices when I did proper valuations of these. I'll leave a link in the description. I think the majority of this info in it still applies. And also remember, you could buy SCHD and get exposure to both companies that way as well, which I think is a fantastic strategy. And the fourth stock we're highlighting today is Medtronic PLC, ticker MDT. Medtronic is in the medical device business. They develop and produce and sell device-based medical therapies to healthcare systems, doctors, clinics, and patients all over the globe. These are products that aging populations rely on, whether we like it or not. In the last year, it's come down to a level that puts its yield in historical territory. And in more recent news, the US FDA established a new so-called Digital Health Advisory Committee, and all of the medical device companies dropped on this news, triggering what strikes me as a classic buy the dip opportunity. And it dipped indeed over the past month. Shares of Medtronic have dropped about 10%, and today's shares are trading right at that 52-week low. While year-to-date, Medtronic shares are down about 7%. I actually picked up about $50 worth this one in my portfolio just yesterday morning. The forward PE is at a 22% discount to its 5-year average at 14.1, one indication of an undervalued stock. And it's put Medtronic at a valuation not seen since it briefly dropped in value in that 2020 COVID crash and where it shot right back up. The Medtronic is also undervalued looking when using dividend yield theory. It's yielding 3.79%, and this is 68% above its 5-year average. Until about a year ago, the stock had never been above a 3% yielder. Looks like a really ideal time to potentially get into a stock like this, right? Medtronic pays that dividend out quarterly in the amount of 69 cents per share in the months of January, April, July, and October for a total annual payout of $2.76. Don't let the fact that this is an Irish company deter you. If you're an American investor, the USA has a tax treaty with Ireland, so you will not have withheld foreign taxes. The dividend today makes up 53% of forward earnings, 59% of forward free cash flow. As long as this is below 60%, we are not alarmed, but I should note that this does seem to be rising. The trend on this graph is going up, something to watch out for. Medtronic has a Simply Safe dividend safety score of 99, the highest possible rating at very safe, making a dividend cut extremely unlikely. The annual dividend has been increasing every year for the last 45 years. The 5-year average annual dividend growth rate is 8%, although the latest raise announced back in May was a lackluster 1.5%, but it's an outlier on an otherwise strong dividend growth track record. Medtronic does a solid job keeping its debt situation under control as well, with a net debt to EBITDA of 1.79 and a net debt to capital of 25%. The average analyst price target for Medtronic is $94.19. That represents about 30% upside from where shares are today. So for the patient investor who wants to collect some dividend income and make some money on the price appreciation side, I think Medtronic deserves a solid look. Now, I think there's some other stocks I'm going to briefly cover here, just real quick to show you that I also think deserve a spot on your watch list. A lot of these are consumer staples just because that particular industry has been hit down pretty hard, as well as real estate, which continues to be in the dumps. As mentioned when we discussed Pepsi, the Coca-Cola, ticker KO, was also deserving a look. This one is down over 16% year to date. Now, there's a lot of concerns about weight loss drugs making products from companies like Pepsi and Coke obsolete. I think that's seriously overblown and has contributed to creating a sweet long-term opportunity for investors. Shares of Coca-Cola are yielding around 3.5% right now. This is a dividend king with 60 consecutive years of dividend raises, putting them in elite companies, so you have to keep them on your watch list. Also in the snack food industry, Hershey's, ticker HSY, has come down 17% year to date. This is one I've been patient on. I've wanted to own it for a long time. I've always felt its valuation was on the high side and that opportunities would present itself. And I'd say an opportunity is presenting itself right here with Hershey's. And I'm actually featuring this one in my next video, so I'm not going to go too deep into this, but make sure you're subscribed for that. Extremely investor-friendly company. They just do most of the stuff that we like to see as dividend growth investors, including double-digit dividend growth. So keep an eye on Hershey's. By dividend yield theory, right now, I think it looks about 25% undervalued. Those who follow me know I've been super bullish on Vici Properties, ticker VICI. Here it is in the $28 range, and if you've been buying it like I was at $30 or $31, you should love it here. Shares are yielding 5.7%, and investors rewarded with a 6.4% dividend raise just last month. This is a newer company that lacks the track record of the majority of my investments, so it's on the riskier side of things, but with Vici, you're getting ownership in some of the world's finest resorts and hotels, including many along the Las Vegas Strip, such as the Mandalay Bay, the Venetian, and Caesar Palace. I've also been buying a lot of Agri Realty, ticker ADC. We could include its more popular peer, Realty Income, ticker O, in this list, as it's also dropped hard. And ADC is down more than 23% year to date. They pay a dividend out monthly, just like O does, and they just raised their dividend payment for the second time this year. So while the last few raises have been on the low side, they're coming out multiple times a year, and we love to see that. And I think these guys just have a better growth trajectory ahead of them compared to their more mature peer, O. They lease their properties out to blue chip tenants like Lowe's and Kroger, other companies that I also invest in, and companies I feel confident will continue paying their rent, so we can continue collecting those monthly checks. Because just be sure to keep those emotions in check when you are investing. It can feel crappy when you buy into a stock and then it drops, but just remember that time in the market greatly outperforms trying to time the market. These are volatile times, but if you have been sticking to an investing plan, now is not the time to quit. In fact, times like this is when I like to go harder if I'm able. And if you want to follow along with the portfolio that I started 1 year ago, in this next video I provide the 1 year update for where things stand from here. In a short year I've created a passive income stream. While it's small right now, I'm setting it up to be something huge, and it's going to happen quicker than you might think. So I hope you check that out. Thanks for watching, everyone, and until next time, keep investing.